Welcome to Charlie's Classroom, where learning is simplified online. Today, we're going to look into one of the heads of income. We know that there are 5 heads of income: income from salaries, income from house property, income from business and profession, capital gains, and income from other sources. So, welcome to the session on income from house property by Charles Ambrose. Now, the income from house property initially involves the determination of gross annual value of a let out property. Now let's look into step by step in order to determine the gross annual value. Step 1 involves the comparison of a fair rental value with the municipal rental value. Now let's first understand what is a fair rental value. So in step 1, we compare the fair rental value with the municipal value. Let's first understand what is a fair rental value. A fair rental value refers to a rent of a similar accommodation in same locality. For example, the rent for a 2 BHK in MG Road may be rupees 25,000 per month, and the rent for a 3 BHK in Commercial Street might be rupees 40,000 per month. Such estimate of the rent for a similar accommodation of the SSE is called the fair rental value. Now, this fair rental value is compared with the municipal value. Municipal value refers to the value of a property as determined by the municipal authorities. The municipal authorities value every property in its jurisdiction each year for the purpose of levying municipal taxes. So in step 1, we compare the fair rental value with the municipal rental value and we take whichever is higher. In step 2, we compare the answer arrived from step 1 with the standard rent. Now let's understand what is a standard rental value. Standard rent refers to the rent according to the Rent Control Act. Where this act is applicable, the rent for the property in the jurisdiction will be governed by the provisions of the act. Presently in India, this act is applicable only in few cities. So in step 2, we compare the answer arrived from step 1 with the standard rent and we take whichever is lower. And the answer arrived at step 2 is called as the expected rent. Now in step 3, we compare the expected rent with the actual rent. Now let's understand what is an actual rent. An actual rent refers to the actual rent charged by the SSE to the tenant for letting out his property. The actual rent must always be considered for the entire period of previous year. Therefore, while calculating the gross annual value, it is a very crucial number. So in step 1, we compare the fair rental value with the municipal value and we take whichever is higher. In step 2, we compare the answer arrived at step 1 with the standard rent and we take whichever is lower. The answer arrived at step 2 is called as the expected rent. In step 3, we compare the expected rent with the actual rent. Now, if the actual rent is greater than the expected rent, then the actual rent is considered as the gross annual value. However, if the actual rent is less than the expected rent, and we find out if the reason of it is because of vacancy, then the actual rent will be the gross annual value. Whereas, if the actual rent is less than the expected rent because of any other reason, then the expected rent is considered as the gross annual value. So this is how we determine the gross annual value. Now let's learn how to determine the income from house property. In our previous slide, we learned how to compute the gross annual value. Now, once you arrive at the gross annual value, the next step is to deduct the municipal taxes from the gross annual value. Now, what are these municipal taxes? Municipal taxes refers to taxes levied by the local authority on the property. It is levied in various names like water cess, sweeper cess, sewage maintenance cess, etc. Municipal tax is levied as a percentage of the municipal rental value of the property. Municipal taxes can be deducted from the gross annual value when the following conditions are fulfilled. First point is that it must be paid during the previous year. Second, it must be paid by the owner or the SSE. When any of these conditions are not fulfilled, the municipal taxes cannot be deducted. So municipal taxes levied but yet to be paid are also not deductible. Municipal taxes of a property paid by tenant of the property or any other person other than the owner of the property are not deductible. Municipal taxes are deductible on payment basis. That is, only amount paid during the relevant previous year is deductible, irrespective of the period to which the taxes paid belongs to. The entire amount of municipal taxes paid during the previous year must be deducted. When municipal taxes paid by the SC during the previous year is deducted from the gross annual value, we arrive at the net annual value. Now, once you arrive at the net annual value, the next step is to claim the deductions under Section 24. Now, under Section 24, there are two deductions which can be claimed. One is a standard deduction, which is a flat 30% of the net annual value. And the second deduction which can be claimed under Section 24 is the interest on borrowed capital. Now, once these deductions are reduced from the net annual value, we arrive at the income from house property. In our next slide, we look into detail what is the deductions which are allowed to be claimed under Section 24. Now, once we have learned to compute the net annual value, the next step is to deduct the eligible deductions under Section 24. So we have two such deductions under Section 24. We have Section 24A and Section 24B. Now, under Section 24A, you are allowed to have a standard deduction, which is a flat 30% of the net annual value, which in short is called as the NAV. Section 24B allows you to claim deductions for the interest on borrowed loan for the purpose of purchase, construction, repair, and renewal of house property. Now, under Section 24B, there are two clauses. We have Section 24B Clause 1 and Section 24B Clause 2. Section 24B Clause 1 allows you to claim the interest for the current previous year, which is basically whatever is the outstanding loan multiplied by the interest rate. Whereas Section 24B Clause 2 allows you to claim a deduction to the extent of 1/5 or 20% of the pre-construction period interest. Now, this 1/5 can be claimed primarily for 5 years from the year of completion of construction. Now, in the next slide, we will discuss in detail how the interest on borrowed loan is calculated and how an SSE can claim deduction under Section 24B Clause 1 and Section 24B Clause 2. Deductions under Section 24B has two clauses, Section 24B Clause 1 and Section 24B Clause 2. Section 24B Clause 1 allows the SSE to claim the interest for current previous year. Basically, it is calculated by taking the outstanding loan and multiplying with the interest rate for the housing loan. Section 24B Clause 2 allows the SSE to claim 1/5 or 20% of the pre-construction period interest. Now let us look at Section 24B. Under this clause, deduction is available for interest on loan borrowed by the SSE for property purposes. That is, where the SSE had borrowed any loan for either purchase, construction, repairs, alteration, modification, renewal, or reconstruction of property. The interest on such loan is deductible under Section 24B. Suppose an SSE has borrowed a loan for his daughter's marriage. By mortgaging his house property, interest on such loan is not deductible, though the property is involved in borrowing. Since the loan is not borrowed for property purposes, it cannot be claimed under Section 24B. In our next slide, we look into detail how an interest on borrowed loan can be calculated using a numerical example. Okay, now in this slide, we will understand how a pre-construction period is determined, and we can also look into a numerical example in determining the computation of pre-construction period interest. Now let's first understand what is the pre-construction period and what is the start date and end date for it. Now, the pre-construction period is a period which starts on the date of the loan taken, and the pre-construction period ends either on 31st March immediately preceding the date of completion of construction or the date of repayment of loan, whichever is earlier. So therefore, the pre-construction period starts on the date of borrowing of loan and ends either on 31st of March, immediately preceding the date of completion of construction, or on the date of repayment of loan. And the period on which it ends should be whichever is earlier of these two dates. Now let's take, for example, if construction of my house is completed on 31st December 2018, then my pre-construction period will end on 31st of March 2018 or the date of repayment of loan if it is paid before 31st of March 2018. But let's remember that if construction is completed on the last day of the year, that is on the 31st of March, then the pre-construction period will end on the date of completion of construction. For example, if the construction of my house is completed on 31st March 2019, then my pre-construction period will end on 31st of March 2019 itself. Now let's look at an example of the pre-construction period. Now in this example, we have two cases, case 1 and case 2. The date of borrowing of loan for both the cases is on 1st May 2015. The date of completion of construction is on 31st of December 2018 for both cases. However, when it comes to the date of repayment of loan, under case 1, the date of repayment of loan is on 30th of September 2021. And under case 2, the date of repayment of loan is on 31st of October 2017. The loan amount and the interest rate is the same under both cases. So therefore, when you look at the overall case, you can see that case 1 and case 2 are similar in all aspects except for the date of repayment of loan. Now let's understand how the interest on loan would differ on case 1 in comparison to case 2 when the date of repayment of loan is at different dates. Okay, now in this slide, you can see that there is a timeline which has been created which shows the financial years from 2015-16 to financial year 2022. Now, as per our example, you can see that the date of borrowing on loan for both case 1 and case 2 is on 1st May 2015. Therefore, on this particular timeline, we will write down the date of borrowing of loan. So our date of borrowing of loan is on 1st May 2015. And you can see that our previous year is from 1st of April 2018, 31st of March 2019, when we are doing the assessment for the year 2019-20. So our current previous year will fall from 1st April 2018 to 31st March 2019. And you can also see that the date of completion of construction is on 31st December 2018 as per both cases. Now, once the date of repayment is completed, okay, now in this slide, we'll understand how interest on loan is calculated. Now we have two situations or two scenarios here. In case 1, you can see that the date of borrowing on loan is on 1st May 2015, just as case 2. So all the aspects with regard to case 1 and case 2 are similar, except for the date of repayment of loan. So the date of repayment of loan as per case 1 is on 30th of September 2021, and the date of repayment of loan under case 2 is on 31st of October 2017. In all other aspects, both cases remains the same. In other words, the date of borrowing of loan, the date of completion of construction, the loan amount, and the interest rate remains the same under case 1 as well as case 2. However, they differ in terms of the date of repayment of loan. So therefore, let us look at how an interest on loan is calculated under these two cases. Now in this slide, you can see that a timeline has been arranged from the financial year 2015-16 to the financial year 2022-23. As you all know, you are currently studying the assessment year 2019-20, which means your previous year is 2018-19. Your previous year commences from 1st April 2018 and ends on 31st March 2019. Now, when you look at the case in our hand, we have the date of borrowing on loan on 1st May 2015. Now, let us assign this date on our timeline. Now, on the timeline, you can see the date of borrowing of loan is on 1st May 2015. And you also know that our current previous year is falling from 1st April 2018 and ends on 31st March 2019. You can also see that the date of completion of construction is on 31st December 2018. Now, as we have learned earlier, the pre-construction period commences from the date of borrowing of loan and ends on 31st of March, immediately preceding the date of completion of construction, or the date of repayment of loan, whichever is earlier. So therefore, in case 1, you can see that our pre-construction period will start from the date of the loan being taken, which is on 1st May 2015, and it will end on 31st of March 2018, which is immediately preceding the date of completion of construction, or the date of repayment of loan, whichever is earlier. However, in the case 1, the date of repayment of loan only happens in 2021. Therefore, the date of completion of construction will be taken as 31st of March 2018. So a pre-construction period starts on 1st May 2015 and the pre-construction period ends on 31st March 2018, because this is the March 31st, which immediately precedes the date of completion of construction. Now you can see that in case 1, our start date is on 1st May 2015 and our end day is on 31st March 2018, which is the immediately preceding to 31st of December 2018, which is the date of completion of construction. So our pre-construction period ranges from 1st May 2015 to 31st March 2018, which is 35 months. Whereas if you look at in the case of date of repayment of loan under case 2, falls on 31st of October 2017. So let us decide what will be our pre-construction period for case 2. In case of this situation, our date of repayment of loan will start on 1st May 2015, just like case 1. However, the date for completion of a pre-construction period will not be 31st of March 2018, but instead will be 31st of October 2017, because the date of repayment of loan falls much earlier than the date of completion of construction. Therefore, our case 2 pre-construction period will be from 1st May 2015 and will end on 31st October 2017. Now you can also see that how pre-construction period is calculated under case 1. Now under case 1, you can see that the loan amount was rupees 10 lakhs and the interest rate was 12%. And the pre-construction period under case 1 was 35 months. Therefore, you will take the loan amount multiplied with the interest rate into 35 months, which is our pre-construction period, and divide by 12 months, which comprises the number of months in a year. Therefore, under case 1, the pre-construction period interest is rupees 3,50,000. Under case 2, you can see that the loan amount is 10 lakhs and the interest rate is again 12%. However, the pre-construction period under case 2 is 30 months, and under pre-construction period for case 1, it was 35 months. Therefore, you can see the corresponding values for pre-construction period under case 1 and case 2 as 3,50,000 and 3 lakhs respectively. So the formula to calculate the pre-construction period is taking the amount of loan, multiplying with the interest rate into the number of months in terms of pre-construction period divided by 12 months. This will help us to calculate the pre-construction period interest. However, please remember that we have learned earlier that the entire pre-construction period interest cannot be claimed in 1 year. we can claim 1/5 or 20% of the pre-construction period from the date immediately after the completion of construction. So under case 1, 3,50,000 was the pre-construction period. 1/5 or 20% of it can be claimed. So therefore, the pre-construction period amount which can be claimed during the previous year is rupees 70,000 under case 1. And under case 2, the pre-construction period interest was 3 lakhs and 1/5 of it is 60,000 rupees. Now, this pre-construction period can be claimed in 5 years. That is, from the financial year 2018-19 to financial year 2022-23. Primarily because you can see that the entire pre-construction period gets completed on 31st March 2018. And therefore, from 1st April 2018-19 onwards, the SSE can start claiming for the pre-construction period in 5 successive years. However, after we complete the pre-construction period interest, it is important to note that you can also claim the current previous year interest under section 24B clause 1. Whatever computation which we have done so far was under section 24B clause 2, which typically talks about pre-construction period interest. Whereas section 24B clause 1 talks about the current previous year interest. Therefore, to compute the current previous year interest, all we need to know is the outstanding loan, the interest rate, and the number of months. So therefore, in case 1, the loan amount was 10 lakhs, the interest rate is 12%, and for 12 months, which is typically for 1 year, the total interest amounts to rupees 1,20,000. Now, when coming to case 2, you can see that there is no any outstanding loan. Now, why is there no outstanding loan during your case 2 situation? This is primarily because under case 2, you can see that the loan was repaid on 31st of October 2017 itself, which means that there was no any loan outstanding during your current previous year 2018-19. Since the loan was already repaid prior to it, you will not be paying any interest during your current previous year, which is from April 1st, 2018 to 31st March 2019. Therefore, under case 2, there will not be any outstanding loan and the interest amount under section 24B clause 1 for case 2 will be nil. Now, this particular table will help you understand how interest can be claimed over a successive period of time. Okay, now that we have learned how to calculate the pre-construction period interest and the current previous year interest, let us see how this amount can be claimed in different series of years. Now, this column talks about the pre-construction period interest. We have already calculated the pre-construction interest under case 1 as 3,50,000. Now, this can be claimed from the financial year 2018-19 onwards for a period of 5 years subsequently following the year of completion of construction. So the 3,50,000 into 1/5 will give you 70,000 rupees. So from 2018-19 onwards, the SSE can start claiming pre-construction interest of 70,000 for a period of 5 years. That is from 2018-19 till 2022-23. Now let's look at how the current previous year interest is being computed. Now currently we are studying the assessment year 2019-20. Therefore, our previous year is 2018-19. Now in 2018-19, you will have to check whether the loan is still outstanding or not. Now, as per case 1, the loan is repaid only on 30th September 2021, which means that during 2018-19, the loan is still outstanding. Therefore, you will take the loan amount, multiply it by the interest rate into 12 months. Because for 2018-19, that is from 1st April 2018 to 31st of March 2019, the loan is still outstanding. Therefore, calculate the interest for 12 months. Similarly, when you calculate for the financial year 2019-20, the loan is still outstanding. Therefore, the interest will be 1,20,000. Similarly, for 2020 and 21, the loan is fully outstanding throughout the year. So therefore, again, 1,20,000.
But however, when you come to 2021-22, you can see that the loan was paid on 30th of September 2021, which means that you need to pay the interest only for a period of 6 months. That is from April 2021 to September 2021. So April to September, we get 6 months. So take the loan amount, multiply it into the interest rate for a period of 6 months. You get the interest as 60,000. Now, how do we claim this interest on loan, both pre-construction period and the current previous year interest on our income from house property? So when you are filing the returns for the income from house property to show the interest on loan, since we are dealing with assessment year 2019-20, we will look at only the data related to the year 2018-19, which is our previous year. So in our previous year, the pre-construction interest was 70,000 rupees and our current previous year interest is 1,20,000. Therefore, 1,20,000 plus 70,000 gives us 1,90,000. So on your deductions under section 24, under interest on loan, you will claim rupees 1,90,000 under case 1. Now let's see how it is computed for case 2. Now under case 2, you can see that the interest was already computed for pre-construction period, which came up to rupees 3 lakhs. And this 3 lakhs cannot be claimed in 1 year itself. It can be claimed in 5 subsequent years after the completion of construction. So just like how we did in case 1, here the 3 lakhs is taken 1/5 each year. So it comes to 60,000 for 5 subsequent years, starting from 2018-19 till 2022-23. So the pre-construction interest is 60,000 each of the year. However, when you look at the current previous year interest under case 2, it shows that there is no any current previous year interest. This is primarily because the property loan was repaid way long back on 31st of October 2017 itself. Since the loan is already repaid, there is no loan outstanding from the assessee's perspective, right? Since there is no loan, there is no interest. And therefore, you can see that the amount of interest for current previous year is nil. Therefore, the total interest on loan which can be claimed under section 24B clause 2 will be only rupees 60,000 under case 2. Now, I hope you have understood how the deductions under section 24 works, both from clause 1 as well as clause 2. Now, once you have understood the amount of deduction which can be claimed for each of these cases, the next step is to see what is the limit to which you can claim. Now, there is a limit on which an interest deduction can be claimed for the use of property. Now, when the use of property is on let out basis, there is no any limit in terms of claiming. However, when you are dealing with a self-occupied property, there is a limit on interest deduction. If the loan is taken for repair and renewal, the maximum amount of deduction which you can claim for a self-occupied property under the interest on loan is only to a maximum of 30,000 if the loan is taken for repair and renewal. However, if the loan is taken for purchase or construction, you have to see the date of borrowing of loan. If the date of borrowing of loan is on or before 1st April 1999, then a maximum of 30,000 can be claimed. However, if the loan is taken after 1st April 1999, then a maximum of rupees 2 lakhs can be claimed. Now remember, this is only in case of self-occupied property. In case of let-out property, there is no limit. So whatever interest which you compute for a let-out property in case of interest, there is no limit you can claim to whatever amount which you arrive at. However, in a self-occupied property, remember that the limits are maximum of 30,000 if the loan is for repair and renewal. And if it is taken for purchase or construction, see the date of borrowing of loan. And it is 30,000 and 2 lakhs. I hope you have understood the computation of interest on loan. Thank you for listening. Happy learning experience.